All right, welcome to another edition of Real Estate Accredited, our multifamily real estate virtual meetup every Thursday at 7 p.m. Eastern Time. My name is Philippe Schulligen. I'm with Boost Capital Group. My partners are Jeff Rodriguez and Chris Price. And tonight we are going to discuss facing asset management headwinds in commercial multifamily real estate. Short disclosure, Boost Capital Group does not provide tax or legal advice. The material herein is provided for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy or sell securities. So with that out of the way, let's begin. I often say to my students who are learning about multifamily properties, the acquisition, though complicated, long, difficult process, is often the easiest part of the whole process of owning a property, because there are many challenges, and I selected a few here. Those are the most critical, I think, in my opinion, and I experienced all of them. So hopefully I'll be able to share some insights and help you learn a few things here. So among those challenges, property management, increase in expenses, drop in occupancy, crime surge, low collections and professional tenants, recession, and otherwise unfavorable economic environment. Let's start with property management. So our model, and typically of syndicators, their model is to have third party perform property management. And when you start your career and you enter a new market, it's going to be critical to pick a good property manager for the success of the investment, because they are the ones who are going to firsthand, most of the time, execute your business plan. You're going to oversee them, but they're the ones who are running the show on a daily basis. So the way to have a healthy relationship is to establish clear performance metrics. So you're going to set goals in occupancy, in collections, in turning units or renovating units, if that's your business plan, or implementing other parts of your business plan. And what you're going to do is just regularly evaluate their performance. Talk every week about how is the occupancy, how are the collections, how many leads were gathered that specific week, how much money was collected, who is late, and maybe start following up. Are there promise to pay from tenants who are late, or maybe just start the eviction process? So it's high level, obviously, but the idea there, you have metrics, performance criteria that you define, and you're going to, on a weekly basis, have a discussion with the property manager and make sure that they are doing what they're supposed to do. The next thing is, depending on the size of the property management company, sometimes, and I would say all the time, you're going to want to do that, but audit expenses. You want to make sure that the appropriate expenses have been applied to the property, because sometimes an expense that doesn't belong to the property could be applied by mistake. I experienced that firsthand with my very first PM. And usually you can see, based on the size of the operation and the way they're organized, smaller shops, it's not unusual. Larger companies, usually they have better processes in place. There's definitely something that you want to check. And that, for instance, if there is a regional property manager who is going to oversee the team. They're going to do a lot of the quality check before you get to see what's going on. If you were to deal firsthand with a property manager, there may or may not be that oversight. So now you have to do additional oversight. And at the end of the day, if they don't perform, if whatever plan you had or suggestions they made to increase, let's say, traffic that came to the property, any initiatives in marketing and so on, it doesn't pan out, and maybe they're just not the right fit, or they're not good property managers, and that's probably when it's time to change. And again, talking from experience, you may try to do as much due diligence as you can upfront, talk to their clients and look at their reporting structure and the way they're organized and so on. You're not going to know until you start working with them if they're going to be able to perform or not. Do not hesitate to change, but it is tricky because you may not have that many options. Hello, Carl. Hi, how you doing?
I'm good.
All right, thank you for joining. I felt lonely for a bit, so I just started the call already. I can go back for a sec. We were talking about facing asset management headwinds this evening. Hope you're doing well. So let me carry on. The next topic is, what do you do when there is an increase in expenses that you didn't expect? So over the past years, and especially since COVID, as there has been significant increase in prices. And here, that's an illustration, that's data coming from Yardi, which is one of the top 3 data aggregator, let's say, in the multifamily world. And it's showing between 2022 and 2023 an 8% increase in expenses, and between 2023 2024 6%. And I know a lot of deals number of years ago, they were underwritten with maybe 3% increase year over year on expenses, or in other words, inflation. And while rents have increased some time ago, quite a bit in 2020, for instance, expenses didn't increase directly as much at the same time, but it came back with a vengeance. It's been significantly higher. And actually, I believe between 2021, 2022, there's another 6%. So when you add just simple math, you're looking at 20% increase over 3 years. This is significant. And there's been a number of markets where there was additional increase, particularly on taxes in Texas and on insurance, I believe in Texas as well, and in Florida particularly. But insurance has been higher everywhere. And for the reason that we see here is just because all the costs being higher, insurance rates have been higher as well. So what to do in that case? It's really, the idea is, look at where you're spending money, look at the trends, look at what is much higher than your budget, try to understand why and mitigate the increase, and always look at how can you save money. That's more specifically, if you are with a bigger shop, again, with a larger property management company, you'll be able to negotiate better rates with vendors and suppliers because they are managing more units, so they may have better prices. So that helps. And otherwise, think about using technology to streamline operations and reduce labor costs. And we have a good example on a property that I'm asset managing right now. We had a change of PM recently. And interestingly enough, they use AI for sorting out initial interactions with potential tenants, with leads. So if a lead is either sending a text message to the phone number for the property or calling the phone number, they will talk to an AI. And I listened to some of the calls because they're available to us, and it's remarkable. I don't think people realize they're talking to an AI. It's very good quality. That is very simple question and answer. And in case it becomes a little bit too complicated for the AI, they would pass and ask to book a call with an actual leasing agent. So something to consider. We're using all these strategies. Something else actually that we'll mention later on. Always good to have some reserves, to have some dry powder that you can use in situations like that, and give yourself a little bit of a margin. Next topic, what if you have a drop in occupancy? And goes back to what I mentioned earlier with when working with the property manager. You have targets on occupancy, healthy occupancies above 90%. If you can hit 95, obviously it's better. 90 to 95 is a healthy place to be. Usually, if you're above that, it means that your prices are probably too low and you can increase your prices. But obviously, here we're talking about a drop in occupancy. The first area to consider is enhanced marketing efforts. And our number of websites out there, apartments.com. I know this Zillow is in some cases is popular as well. Those are companies where you can buy a package for a monthly fee to place your units and advertise a little bit, make your apartments come first, basically, when people do a search. Next, competitive amenities and services. Always an interesting idea to explore, to see maybe you can offer some storage units or rip some of the rooms to make common areas if there's space available. Or maybe it could be just set up a little picnic area, or a grill or something of that nature that could improve the overall how the property will perform and could be appreciated by tenants. Always something to consider. There could be also higher security or things of that nature. I forgot to mention in the marketing, and I think it's maybe I should have written that down. Obviously, you may want to consider offering concessions and, if necessary, lower the rents. So the third point here that's also very important, implement tenant retention strategies, loyalty programs, renewal incentives. And it could be, we just did, for instance, a party at one of the properties a couple of weeks ago, just to build a sense of community and to have people enjoy the place where they live and just want to stay longer. That's the idea. So that's a very important strategy to consider. But otherwise, you may want to be a little bit flexible on the rent increase to retain tenants, and that's what is meant by the loyalty program. And or renewal incentives, the same thing. And you can also offer referral fees that you can give to tenants for people that they refer to the community. Crime surge, again, experienced that firsthand. I think two of the properties that I'm involved in experienced shootings. And obviously that is a tough situation to be in. Tenants are going to be scared. It's terrible. Not only for people who are injured, the whole community is going to be shaken by that. So I'm talking about serious crime in that case. Sometimes there are other less important crimes. Nonetheless, like any crime is bad, obviously. The solution, add cameras, better lighting, maybe a gate if there is something like that available. Make sure the gate is working. Talk to the police and ask them to patrol on a regular basis just to show that the property is being watched. And safety workshops is also an idea, and just tell tenants to report anything that they see, they have to report it. Now, I know there are some cities where maybe there's not as much police as there should be, so it's a little bit more challenging. You may want to consider private security. Low collections and professional tenants. Obviously, what I mean by that expression, there are people, unfortunately, who are abusing the system. Sometimes they may produce inconsistent paperwork for their screening or sometimes a fake social security card that happens. So it's very important to have strong tenant screening process up front. Check their paperwork, and also you can define a credit score, for instance, a set of criteria to make sure that you're going to be able to have tenants that meet the criteria to move in the apartment. It's more of a challenge with Class C properties with lower rents, because lower rents means you're going probably to lower also the credit score, and that's where potentially these tenants, they're not going to be the best tenants. Much more challenging with Class C properties. Second bullet point, implement strict rent collection policies and late fees. Basically, the idea there is usually the rent is due on the 5th of the month. People are late, they're going to incur late fees. And first time you're going to give them a warning, give them maybe an additional time. If they are repeating, you're going to charge them. And then if they don't, for instance, produce a promise to pay if they're really late, then you can start the eviction process. One interesting idea, we've not used that yet, but something that we may consider using a rent reporting service, which basically, if they pay their rent on time, it's a bonus for their credit score. They don't pay on time, that's going to impact their credit score. So definitely something to consider. I heard about that several times. They never had the opportunity to implement, but we are considering that actually on a particular property. And obviously stay informed about local eviction laws and procedure. Sometimes laws are changing. PM would be very much aware of that in real time, but things can change and sometimes can be backed up. So it's always good to stay on top of what's going on when it comes to evictions, and sometimes think about other strategies. So for instance, cash for keys, meaning that it doesn't mean that you're going to pay people to leave, but you may say, okay, we're going to consider only some of your balance if you leave, or otherwise we're going to push with the eviction, which having an eviction on a credit report is very harmful. Our last page, unfavorable economic environment and recession in general. There are several angles to that, but let's say you are in a tough situation, the economy is bad, maybe the income is not coming as needed, etc. Really look at diversifying your tenant mix, because you want to reduce reliance on any single industry or demographic. So if you have diverse tenant base, they may be impacted differently if the economy goes bad. So that's something to consider. Not always easy to implement, something to consider. That's why if you think about the unit mix and having different unit mix going from 1 bedroom, 2 bedroom, 3 bedroom, usually you'll have a wider range of demographic that you're going to attract. So that's a way to achieve that. And the industry, that's something also, when you select your market, you're going to want to be in a market that has multiple industries. You don't want to have all your eggs in the same basket, just what happened in Detroit several years ago. Second recommendation, and I underline because this is, I think it's the key to a lot of the issues that we discussed so far, have cash reserves. The minimum $1,000 per unit, the more the better, obviously, and look at your break-even occupancy and things of that nature to be able to pay the debt particularly. Some strategies, flexible lease terms, maybe like shorter terms sometimes, it can help people and an incentive for people to move in. They want to stay a shorter time. And otherwise, it's like cost-effective property improvements is going to be better said is on your expenses. That's going to be actually a better advice there to be able to withstand unfavorable economic environment. Another angle to that is think about the economy where we are right now, which actually it's not terrible, but interest rates are high, right? So we are effectively in an unfavorable economic environment. And as a result, real estate prices went down. And somebody who bought a property 5 years ago, they want to sell now. Maybe it's not necessarily at the price point that they would like, and it might make more sense to wait a year, for instance, for interest rates to go lower, so prices are going to be higher again. In that case, what does it mean? You need to be able to sustain a longer hold. And I'm involved in a few properties that are in that situation right now, because the environment is such, it's not, the returns would not be great at all. And we're just going to wait and sell a little later. So that's also something to consider. So that's all I have for this evening. Let me know if you have any question. Carla, if you're still with me.
Yes. Yes, I am sorry I'm commuting, Philippe. But one question I did have, I noticed a lot of times you talked about the gates and security. Now, I have a sister that's single, so she always looks for apartment complexes that have gated, secure entrances. But usually that's not a lot of the plans that I've seen on a lot of the value add properties. Is it very expensive to do that? I'm just wondering why they wouldn't do that more often than what I see.
The problem with gates, and I know I had one on my second property, and actually when I moved here to Atlanta, we rented for a bit and there was a gate as well. And you can be sure that at least 30% of the time, the gate is damaged. People,
Mhm.
it's just like the mechanical thing breaks, or people don't pay attention. They try to go when the gate is closing or whatever, and then it's broken. It's very expensive to maintain. And I'm talking about, I think there are better systems out there. Obviously, the more complex the system is going to be more expensive, but I don't know. And that's something I discussed with property managers. There's no perfect solution, unfortunately. And unless you go very high end property, and let's say they have a garage door, so it's more simple, like garage doors with underground parking. I would say like higher end, like class A properties, they may have things that are more reliable. Yeah.
Oh, I guess the other question I had was about, you mentioned that the cost of supplies and stuff had gone up. Then after COVID hit, there were some syndicators saying that they couldn't find any properties, value add properties. They said they felt like they were too expensive. The prices had gone so high, they were too expensive. And then it actually was cheaper to build new properties as
Right.
opposed to do value add at that point. So where do you think we are now in terms of that pendulum? Do you still
Oh,
think it's better to do value add, or is it actually cheaper to build
oh
up from
no,
scratch? Because
yeah.
it seems like always building is it's always expensive if you build from scratch,
Yeah, yeah,
ground
yeah,
up.
yeah. No, that's a good question, actually. Like with the interest rates being where they are, we are at a point where I think we are at a local bottom of the market. So interest rates have brought prices down. And of course, I think in 2020, the prices, or actually a little later, it was 2021, between 2021, 2022, that's where the prices were the highest. And it was just nuts. And indeed, in some cases, it was more expensive to buy, to do a value add deal to buy at that level than building new. But sometimes it doesn't make sense to build. You cannot add new construction if there's no room, for instance, right? There's no land to build. So there are some markets where it makes sense to think in those terms, and some other markets where it doesn't, because it's just like the zoning and whatnot doesn't allow for additional units. But in any case, to answer more directly your question, I think we are at least 20 to 30% lower, actually, just from last year, I would say, which is probably 40 at least percent from the peak of the market. Value add right now, it makes a lot of sense. And let's see if I can pull up. I don't know if I have. Yeah, here, see this chart, the cap rate. So cap rate is inverse to the prices. So higher cap rate means lower prices. And you can see how cap rates have gone much, much lower early 2022. And since then, they inflated a lot. So at least if I take the blue line from 4.5 to 5.7, that's a significant. You can see how steep the curve is, and it goes along with the interest rates. You know what that means? So that was the peak of the market, which would be the trough on a cap rate chart. And here we are at a local bottom. And we can do simple math actually. Let's say we do 100 unit divided by 4.5%, right? So that's 2022. And we do 100 unit divided by, right? So that's 20%. So that change in the blue curve, which actually, and here it's showing a forecast. This is an older chart because it was from early 2023, but we are more or less in this area. But see here, it's showing about 20% between the peak of the market and now. So right now you're buying at 20% discount compared to the peak of the market. And indeed, you want to make sure that you're not going to be in that situation where the cost to build is lower than where you buy. However, I would say if you consider the 20% discount to the peak of the market, and in parallel, the costs have increased of 20%, now your gap between the price of construction to where you're going to buy is going to be even wider, right? 100%, you can see on the chart, like we are at the local bottom of the market. And you can see like what happened after 2008, 2009, when we passed the local bottom of the market, it went nuts. 10 years straight. It doesn't mean we will experience the same, but just to give you an idea how quickly things can turn actually.
Yeah, I guess the only last thing I want to mention was I'm not sure if you get the Wall Street Journal, but they had an interesting article yesterday on apartment syndicators, and the main guy they talked about in there was Brad Sumrock.
Yeah.
He's based here in DFW. Did you see that article?
Yeah.
Yeah.
I read it diagonal, but yeah, it was.
I've been to a couple of his conferences. I've never been one of his students, but I've been to a couple of his conferences. But he has a lot of students in the Metroplex, a lot.
Oh, and, yeah, I'm sure. Yeah.
You know, he's been doing it for a while.
He's the OG. He's like the first one we did multifamily. A lot of people have followed since. But I understand he's a little more humble right now. But each time I listen to some of his stuff, he was a little bit like too salesy, in my opinion. And that didn't sit well with me.
Yeah.
And yeah, and if the 6 properties that went into bankruptcy last year in Houston, the guy was running that, the main guy, he was a Brad Sumrock student, actually. He was. There's been, I think, again, it's behind us. The bad actors, yeah, I guess, not necessarily bad actor, but let's say like the less professional or efficient or whatever you want to call it. These people are in trouble. I am myself in my own portfolio of investments, in some cases, experiencing some challenges. And I know people, though I would say like relatively limited, I know people who experience much more serious challenges. And that's where we took very seriously doing a very thorough due diligence. And now it's at the point we have a professional underwriting team working in real estate, consulting in real estate in general. So professionals in the industry re-underwriting for us whatever we receive from sponsors. And we ask them to stress test. Like, how does it look? Is there enough reserves? And they give us their analysis. And I know that in some cases, these deals, they don't even pass our due diligence. And that's why we check the sponsor, background check, track record, and so on. And then we look at the deal, very thorough underwriting, looking at the market extensively. And I think that's what it takes, because you really want to put all the odds in your favor when you're investing. And then at the end of the day, it's like just put a little bit in different properties.
Yeah. I think also that article didn't really, it tried to slant him in a negative light, but I think that nobody could predict that the interest rates were going to rise that fast in that short period of time, no matter who you were. Nobody saw that coming. So it's hard
And
to really
yeah,
blame somebody when the government raises the interest rates that high in less than a year or so, 18 months.
yeah, that's right. But again, that's why now I'm very cautious about
Yeah.
interest rates, and
Yes.
especially interest rates. If you have a rate cap for the interest rate in conjunction with reserves, such as what Rise 48 is doing, then it makes sense. But again, this is advanced strategies for people who know what they're doing. To my students who are beginning, stick to fixed rate. You want to control your destiny, because otherwise it becomes so complex. You need to stress test, etc. And you need to have, so now the reserves that I mentioned in this case, they have to be in addition to the other reserves that you must have for your operations. So that's where it becomes, I think, a little more challenging to underwrite with such like advanced, what I would consider more advanced strategies like that. All right.
Yeah, I thought that was interesting. So I just wanted to see if you had seen it or not.
Oh yeah, of course. Yeah, everybody in the community has seen
Yes.
that article. It wasn't too bad actually. A lot of students,
Yes.
they were like, "Yeah, I believe in him." But yeah, there were other articles about him that were a little more negative. But yeah, it's the old guard. It's the old guard
Yeah.
of people who started. Yeah.
Very good.
All right, Carl.
All right. Very
Thank
good.
you very
Well, have a
much
good
for
evening.
joining us.
Okay.
And maybe, hopefully, if you can join next week, you're welcome. Otherwise, in any case, enjoy the weekend and we'll talk soon.
All right. Very good. You do likewise. Thank you.
All right. Thank you. And
All right. Bye-bye.
thank you. Thank you, everyone, for joining. Just wrapping up the recording here. Thank you again for joining, and we'll see you next week. Have a good evening. Bye-bye.